This week on Phil's Tax Hacks and Other Retirement Facts, it's all about looking at the tax proposals or conversations between the two candidates as we get closer to the election. So this week, let's dive into what Trump proposes and what Kamala proposes here on Phil's Tax Hacks and Other Retirement Facts. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome to the podcast. Thanks for hanging out with Phil and I. Phil, how you doing, my friend?
Doing good. Yeah? Loving the fall.
Well, there you go. Hey, remember this? Read my lips. No new taxes. Do you remember that?
Yeah. Yep. Campaign promises.
Yes, sir. Yes, sir. 1988, George Daddy Bush, as I called him, a lot of times, George H.W. Bush. That was one of his things, and of course, he went on to not do that at all. But anyway, both candidates are starkly different in this election. And while we don't really try to talk politics, policy sometimes can certainly or has to infect or inflect on our conversation pieces because it affects what we do with our money, right? So let's talk a little bit about
policies have a way of sticking around for a long time.
And they can, exactly. So let's get into it. We got a lot to cover, so let's just dive in. We're going to start by we're just kind of breaking down the issues that both candidates, or some of the things that both candidates are talking about from a tax standpoint, and just an economy and a money standpoint. And I'll let you run with it. But let's start with Trump. Okay, so that's just because it's the first thing on my list. So let's start with Trump's tax proposals. Let's start with the corporate tax conversation. Where are we at?
So corporate, he's proposing lowering taxes again, down to 20. Remember where he started in his first term, was at 28, took it down to 21. Now he's talking about taking it to 20, and then also having the potential to drop it.
We're currently at 21, 15. Right?
Right. Yeah, we're currently at 21. Yep. So, and then he's proposing dropping it potentially even to 15 for those that manufacture domestically. So again, he's trying to encourage bringing a lot of the production manufacturing back into the U.S. So, which that's always the battle with corporate tax rates, right? We've got to be competitive in the world. Companies in the U.S. and other countries, I mean, they're always looking at, what is the tax consequence of where they're going to headquarters. So ultimately, if our rates are higher than everyone else, that starts to kind of incentivize negatively companies to go elsewhere. So, so this is a proposal to try to bring some of the companies back to the U.S. and the manufacturing.
Yeah, very true. So, and what I'm going to try to do here is I'm going to try to have us bounce back and forth so we can kind of keep them tight so we don't go through too much stuff and then talk about the other ones. So real fast, what would be the impact if that was the case with Trump?
Well, I mean, again, the goal is to stimulate the economy. It should start to bring back more of the manufacturing, some of the jobs that have been lost to overseas because of lower taxes. Bringing them back to the U.S. So, I mean, that's really the goal. And that's when you look at lowering taxes, the incentive overall is, you might have a lower tax rate, but it increases the base. So if we can, even with a lower rate, have more revenue that's U.S. generated now at a lower rate, we're going to end up with more revenue.
You can think about that example from his first term, if you will, where I think Apple brought back an insane amount of money from overseas when the tax cuts were lowered, because as a company, they owe that to their stockholders and everything else to be as efficient as possible. All right, so that's Trump's corporate side. Let's talk about Kamala, excuse me for saying it wrong. Kamala's corporate side.
I mean, basically, her position is reversing the original tax cut to the corporations of 21, so taking it back up to 28.
Going back to 28, okay.
Right. So I mean, again, it comes back to what's going to happen from the corporate world if that ends up happening. I mean, you brought up a great example with Apple. I mean, are they, once that happens, going to end up moving things back overseas again? Who knows? I mean, only time will tell. And that's why I said, I mean, when you're looking at these issues from a candidate standpoint, you have to look beyond the candidate into the policies and then ultimately the potential long-term effect. Because it's nice to talk about the pros and cons, but ultimately they do have lasting long-term effects. So
and I guess if we're going to throw the positive spin on her raising it back up is some of that funding might go towards some different social programs or whatnot. But at the same time, the concern could be that also suffers the job market too. So it's a bit of a double-edged sword there.
Right. Yep. So, I mean, the positive is it, could potentially bring in more tax revenue up front. Yeah. How long that lasts, who knows? And with that, then, maybe fund some more of these social programs and things that she's trying to do. So,
okay. Yep. And to be fair, there's not been a lot of information put out on her side, to be honest. So a lot of this is stemming from the Biden, I guess, proposals as well. So
it's a lot of it comes through from Biden's budget plan for 25.
Yeah, and we've taken this information and put it through some different things to help us kind of decipher all this based on also things that she's made comments on, because that's just about the most information we have to go off of. All right, so let's now go to individual. That was corporate taxes. So let's go back to Trump and talk about individual income taxes. What's the conversation piece there? We're currently under the TCJA, which was when he was president.
Right. Yeah. So we're under the TCJA, which expires at the end of 25. So that's been a big tax talking point, over the last 2 to 3 years. So his proposal is to make that permanent. So that could incentivize and keep the tax rates lower overall. One of the advantages that he's talking about bringing back that was kind of a downside to this Tax Cuts and Jobs Act is for anyone that does itemize, that's what they call the SALT deductions. The state and local tax deduction is limited to $10,000. So, for anybody that lives in a state that has higher property taxes and then has a state income tax, it's not very hard to get above that 10,000 limit pretty quickly, especially if you've got a second residence. So,
that was removed the first time around, but you're saying they're considering bringing it back in if they make it permanent.
Right. Yeah. So that was part of the original Tax Cuts and Jobs Act when they, made the standard deduction much higher. And again, this isn't going to affect a lot of people because most people still today are falling under that standard deduction. This might help because it's going to take away one of the limitations on, frankly, one of the bigger deductions. Usually it comes down to taxes, interest, and charitable contributions. Those are kind of the big three that somebody might have when it comes to standard deductions.
A big piece of this is that people are certainly excited about, or as a talking point, is the whole overtime and tips conversation, right? That's another piece.
Correct. Yeah. So another piece that he's talking about is not taxing overtime and tips. So again, that could incentivize, especially that part of the economy, for those that do generate a lot of overtime and or get tips, that service industry. So because and that's a lot of people. I think it's a lot of people. I think it's one of those industries that has suffered the most coming out of the pandemic. It's just, any restaurant always having trouble finding people. So maybe this would help incentivize that industry or people working in that industry to come back into it. So, and help
that's a good point. Yeah, for sure. Yep. And then the Social Security benefits, been some noise there as well about maybe eliminating, interesting enough, Phil, I just did a podcast not too long ago with David Walker, the former U.S. Comptroller General of the United States under Clinton and a couple other presidents. Yep. And he was Clinton's administration was the administration that put that, I think, that took Social Security tax up to 85%, right? And it was very interesting to hear his take on some things, on how they had to do some stuff. And of course, he's very much in the camp of trying to figure out how to, basically we need to curtail spending, dramatically, which is part of our problem. So it's a very interesting conversation as well. And so, seeing this Social Security conversation piece here, I wish I would have asked him that question, how he felt about Trump wanting to eliminate that. But unfortunately, I didn't get a chance to do that. But anyway, what's your take on that?
Yeah, and this is one of those things that it's just thrown out there, right? I don't. There's been no specifics on even the tips and the overtime. It's one of those things. We're not going to tax tips and overtimes. We're not going to tax Social Security. That's great. If he can figure that out and make it work fiscally, then that would be a boon for all the retirees. And actually,
how do you pay for it?
Security was originally designed, right? When it was instituted, there was no tax on Social Security.
Well, and the big question is how do you pay for it? And we did get into some of that conversation with David, and it's like, look, one of the things that we have to do, no matter who becomes president, is we have to curtail spending in order to pay and fix for some various different things. And he's like, unfortunately, neither one are really going to be, are really talking a lot about curtailing spending right this minute. And that has to become the focal point at some point. All right, so let's turn our attention to the Harris campaign for individual income tax. And since that was on Trump's, he wants to kind of basically keep the TCJA in place, make a couple of minor changes if they can figure that out. All right, what about on her side?
So she hasn't said a lot about it. It's talking about keeping the TCJA in place, but for the top rates, the top marginal bracket, taking that back to what it was. So it used to be 39.6. Under the TCJA, it dropped to 37. So she's saying for the higher earners, those over 400,000, taking that back up to what it was at 39.6. Again, looking to generate more revenue from the wealthy. And you'll start to see kind of a trend. And I mean, this is nothing new to anyone that follows the parties in taxes. I mean, they're trying to tax more the wealthy and the corporations is what it comes down to.
Okay. She also talking about capital gains changes. This is the big one here.
Yeah. So capital gains, she's looking at ways to generate more revenue again from those that, are the top tier. So taking the top capital gains rate up to 28%. So, I mean, that's an increase from where it is today. Today it's at 20. So I mean that's a pretty significant increase, as well as then taking what's called the net investment income tax. So again, another tax on investment type income. From today, it's at 2.8 up to or 3.8 up to 5%. So jumping that up again as well. So I mean, it's again trying to tax more of those capital gains. Something that happens at the higher level of income. So, I mean, that's, again, what happens from the economy there. I mean, you start to take away some of the incentive for investors is what it comes down to, those that are kind of backing and growing companies, because now their gains that they can generate on that side are going to get taxed at a much higher rate, which, I mean, this has always been the pro and the con, the discussion. You hear about, those big investors out there that are paying lower rates than some of their employees, right? I mean, it's how that happens. Well, this is how it happens. It's a different type of income that they typically earn, which under the current tax laws has for years had a lower tax rate.
There's definitely a chicken and an egg thing going on here. And I think one of the big ones that's really stark for a lot of people is obviously this 25% or this unrealized capital gains tax conversation. And I know initially it was brought up being only the really wealthy over 100 million or whatever the case is. But the fear or the concern I think people have is that this becomes these kinds of things have a tendency to trickle down. And I believe this is actually Elizabeth Warren's initial idea. A couple of years she's tried to float this and it's never really taken off. I saw an interesting breakdown on this, Phil, and I'll tell me what you think about this. So it was using the analogy of the guy who started I think the Lululemon yoga pants or whatever, which is had been blown up the last couple of years. And it said the guy started the business with, like $50,000 or something like that. And now it's worth, his shares are worth like $1 billion or something crazy, right? And so if he was to have to pay, and this again, keeping in mind that this is only for the really, the $100 million people, what does it do to the regular person? Well, if this guy has to pay capital gains on unrealized capital gains on now $1 billion that he just started with something that was 50,000, a decade ago or whatever, how is he going to come up with that $1 billion? He doesn't actually have $1 billion. He's worth $1 billion, right? So you then have to either sell stock or take a loan against the company or whatever. And that can actually hurt business, which then hurts sales, which then hurts people working for the business. So there's a lot of places where this has that kind of, trickle down ramifications that people aren't really necessarily thinking. Sometimes they just hear, oh yeah, let someone who's worth $100 million pay more money. But what if that costs, 10,000 people a job? It's a slippery slope. Am I off there or am I correct?
Oh, no, not at all. I mean, that is 100% right. And that's kind of the point I was talking about the corporate taxes. But at the end of the day, corporations, large investors, I mean, they're not going to end up paying the taxes. They pass that through. They're trying to generate the profit that they generate for their investors, or for themselves if it's an individual like this. But to your point, I mean, that puts that person in a hard place. I mean, another part of the economy that this is going to hit very hard is farmers. I mean, think of the land, the vast amount of land that they have that sometimes passed down generation to generation. What is that worth? And who's going to determine the worth, right? I mean, and to your point, where are they going to come up with it then? So they owe all these taxes. What are they going to have to do? Are they going to have to sell some of the property? Are they going to have to take loans? I mean, it's just, great idea. There's this pot of revenue potentially that we can generate, but you always have to look at both sides of that equation. Yeah, you can do that, but what's the downside overall? And you might generate up front, but then what ends up happening in the long run?
Well, and Mr. Walker made a great point. Again, this guy knows numbers inside and out. He worked for Bush, he worked for Reagan, he worked for Clinton. And he was interesting. He did say that the last fiscally responsible president we had was Bill Clinton, which I thought was an interesting statement because we've had many presidents since then. But he said it's part of the problem is that we don't our leaders don't think down the road, and I think we've seen that time and time again. They think about today, yesterday, and maybe tomorrow, just like literally the next day, because it's all about, especially career politicians, it's all about making sure I just stay in my job versus what is this going to do 10 years from now, I think. And that's where we've got to get some people starting to look at some of these things. I mean, we did the same thing with the COVID response. Now we're seeing stuff coming out saying, oh yeah, well maybe locking kids up and not letting them have socially interact was detrimental to their psyche, or maybe the vaccines did cause some issues. I mean, now we're starting. Yeah, I mean, now it's years removed, and so now you're getting more data, and you can't make knee-jerk reactions all the time. And I get that, medical is a little bit more iffy, but economy, there's tons of data and tons of ways that they can run projections. Data, right. Yeah, that you can run better projections on some of this stuff.
And that was really kind of the point in talking about these up front, is to bring to the forefront policy potential, right? And again, none of these are in law. It takes a lot of work on both parties to get anything through Congress to actually make this law. But at the end of the day, it comes down to this gives you an insight, at least, as to what they're thinking, and what that potentially could be, and where they're going to try to take this country if they get elected. And you have to look way beyond just today, because policies, once they get in place, they're there. And they're very, very difficult to change. I mean, look at the ACA, the Affordable Care Act, or Obamacare, they call it, right? So, I mean, it's that was a policy put in place that it's hard to change at this point to make it different, because it's got its tentacles now into everything. Well, the same thing happens with any of this. And once you make that drastic of a change from a tax standpoint, you have to look at the long-term ramifications to see, well, how does this work? What's the effect long term beyond
it could
today?
It could take decades to unwind. It could take decades to either implement or unwind something, right? So, all right. So a couple more quick things. Other little tax proposals, real fast. Trump's got the tariff conversation and the child tax credit. What do we got there?
Yeah. So part of how he's anticipating paying for some of the tax cuts that he's got in place is through charging tariffs. And again, the incentive here, I think, is trying to bring more of the manufacturing production back into the U.S. And discourage, both imports and exports, and specifically with China. He's got a significant tariff there, which, I mean, we'll have to see how, if obviously this ever comes into play, because just look at the vast majority of what you purchase, where's it manufactured? Is in China. So there's going to be a lot that has to happen to U.S. manufacturing to be able to make up for that. Or, I mean, the price increase that is going to end up happening if there's that kind of a tariff in place.
Yeah, and that's the overarching philosophy. I mean, if you look at his total philosophy, it's how to, bring manufacturing back into the country, which in a lot of different industries we really sorely need, because we saw that in the pandemic. As a matter of fact, at the time we're taping this, Phil, we now have, I think, the longshoreman strike, and we now have the dock worker strike. which is going to cause a real problem for the next 30, 60, 90 days, depending on how long it goes, too, right? Okay, let's go to Kamala. Let's go to some of her tax proposals. Child tax credit, they're both doing the same kind of thing. I think, what, $1,000 difference maybe?
Yep, trying to increase. Yep, $1,000. I think her maximum is up to 6. Trump is at 5. So she's also talking about extending the earned income credit to those that don't have qualifying children. So, I mean, that's kind of one of the things that is generally for somebody with a qualifying child. So, trying to extend that. Home buyers assistance. So there's a $25,000 down payment assistance program. Again, trying to spur on American home ownership. And potentially stimulate the real estate economy. I mean, it's been that economy, that part of the U.S. sector has been pretty strong, up until recently, obviously with interest rates increasing. So there's that. And then also she's talking about the deduction for small business, so those starting a small business currently, they can take a $5,000 write-off for kind of those startup expenses. And she's talking about taking that up to 50. So.
And that could be positive because small business growth is great, and that's where a lot of jobs come from. So that's definitely a good positive there. I feel like with the taxpayer, the home buyers assistance, I feel like that's about the same as Trump's Social Security one. It's like, okay, great, it sounds wonderful, but how are you going to pay for it?
How are you going to do it? Yeah. Because this again, there's not a lot of information on it, but it's here it says the down payment assistance. I mean, I've heard of it referred to as a credit, and we've had the first time home buyer credits in the past, but nothing to that extent. So
the Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
All right, well, let's kind of wrap it up with potential impacts then. I know we're getting a little bit long. Like I said, we'll try to hopefully not get this too much more to 30 minutes here. But what's kind of the long-term look on this, some of the potential impacts that you see?
So looking at different sides, there's a lot of different economic think tanks out there, so to speak, that run the numbers on all these different proposals to say, okay, what is the long-term net effect? I mean, bottom line, both of them are going to increase the deficit. They haven't fully paid for all the different either cuts or credits that are in there. So it can have a long-term overall increase in the deficit. And higher interest rates, long-term as we're borrowing more. I mean, we could be back into that cycle. So with either party, there's no great answer yet.
Yeah, interesting enough, I think, again, that conversation with the former comptroller was like, look, we've got to be careful about market share in the world, because if we lose market share in the world, he's talking about the BRICS specifically, the Brazil, Russia, India, China thing. That could cause lending issues, it could cause borrowing issues, could cause a lot of economic problems there for corporate world and for people as well. So real fast, what's kind of that? We've got this interesting little chart here, or this interesting little kind of breakdown. What's some of the impacts on things like GDP, capital stock, wages, that kind of stuff?
Right. So, I mean, you talk about, our place in the world. I mean, GDP, what's our gross domestic product? And this is based on the Tax Foundation and their what they call their equilibrium model. So they've run the numbers on both the candidates and their proposals. Under Trump, it stays about the same. It's down 0.2%. They're saying under Harris, it's down 2%. So which again, if you look at kind of the goal and the direction, taxing corporations, that's where a lot of our GDP comes through is that. So, I mean, lowering the GDP there. Sure. Capital stock, the investment side on Trump's, it's a little bit positive 0.3. On Harris's, it's -3, which again, no surprise there because of the increase in tax and capital gains, and that whole side of the equation. They're proposing or looking at pre-tax wages, so what's the effect on the average Joe, the wage earner? Under Trump's, they're saying it could go up by 0.6%. Under Harris, down 1.2%. And then similarly, talking about full-time employment, interesting under both parties, they're anticipating losses of jobs, 387,000 under Trump, 786 under Harris.
Okay. Interesting.
So again, just looking at it from that high level, it kind of makes sense from the GDP, the jobs, the company standpoint. Trump's trying to incentivize and grow that. Harris is looking at that as more of a place to generate tax revenue,
Yeah.
So.
Okay. All right. So hopefully that helps a little bit with the breakdown. Again, not trying to be too, partial one way or the other. It's just a matter of what you feel, what you believe, or what you feel you need to see,
Right.
Yeah.
And that's really, again, like I mentioned, the whole goal of this isn't to say vote for this candidate or that candidate. It's take the candidate out. Yeah. It doesn't matter. Just understand the direction, and the potential, and then, vote for what you feel is right. At the end of the day, and look at the long-term effect. So,
yeah, I've always heard growing up that my dad used to tell me, people tend to vote their wallet. That always stuck with me. People tend to vote their wallet. When your wallet is doing pretty good, no matter what walk of life you're in, you tend to want to vote for something similar that's going to keep you in that, vein. And I think, certainly that right now, the wallets have not been good for the last number of years. And of course, we've got a lot of number of, natural disasters hitting right now and lots of different, the strike we just talked about. So there's a lot of things that are it's certainly very contentious. So you've got to do yourself and I think your family the favor of thinking about all of the effects of things, not just one or two pieces, whether it's economic or social or whatever it is that kind of lights your fire. I think you got to do yourself the service of thinking that through long-term, not just in the short term. Yeah.
Right. Which, kind of ties around to, when we talk to clients about taxes in retirement all the time,
okay.
What I tell them all the time is the reality is if you're looking at taxes currently, you're going to get the wrong answer every time. You have to look at taxes in that long-term picture.
Great point.
Because what you do today has one effect, but it sets you up for this other effect long-term. Same thing we're talking here. There's a lot of potential benefits you could get from a tax standpoint today, but then what is that long-term effect? So just understand,
right?
It's a lot of numbers trying to decipher back and forth, but you have to dig through it to some extent and take that into account, when you're looking at this decision. So.
Yeah, absolutely. All right. Well, we'll get out of here this week. So if you got some questions, you want to bounce some things off of Phil or you just do some research, right? Dig into a little bit of stuff,
absolutely.
Do a little bit of research for yourself. There's a lot of stuff out there you can find anything to support your preferenced argument, but do yourself the favor and look at both sides of things, no matter what the conversation piece is, and see how it's going to affect you, whether it's you're nearing retirement, whether you're working, whether you're younger, whether you're whatever, obviously it's still going to affect you. So hopefully we helped you a little bit there along the way. And as always, don't forget to subscribe to us here on Phil's Tax Hacks and Other Retirement Facts. You can find us on Apple, Spotify, YouTube. Check the links in the show notes. We'll have some different links to some of the things we sourced for today's conversation. We'll put some of that stuff in there so you can go do the research on your own as well. So we'll put up some of those links for you guys to check that stuff out. And if you need some help, please reach out to Phil at philstaxhacks.com. That's philstaxhacks.com. And we'll see you next time here on the show.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.